Welcome back to Investing Talk podcast. Today, we're taking a close look at ServiceTitan. Really trying to answer the question, is ServiceTitan a good time to buy now? Our goal here is to, unpack all the information we have, the sources, help you cut through some of the noise, and get right to what's important for your investment decision. And hey, before we jump into the numbers, we'd love to hear from you. If you find this useful, please think about subscribing, maybe liking the video, leave a comment. It genuinely helps us keep bringing you these analyses. Oh, and if there's a company you want us to look into next time, just drop the name in the comments below. Or if you're feeling particularly generous, you can always buy us a coffee. The links for that are in the show notes. Okay, so let's unpack this ServiceTitan situation. Before we get into the sort of buy or sell nitty-gritty, what exactly is ServiceTitan? What's its place in the market? So it operates a cloud-based software platform, right, specifically for contractors and service businesses. Think about, plumbers, HVAC companies, electricians. They use ServiceTitan for pretty much everything.
Managing customers, scheduling, dispatching, even invoicing. It's really an end-to-end kind of thing in that growing SaaS market, software as a service. The sources we looked at put its market cap around $10.3 billion. So kind of mid-sized player compared to some of the tech giants out there.
Yeah, and what's fascinating here, when you dig into the fundamentals, you really see this clear picture. It's a growth company, absolutely, but one that's still, finding its footing in terms of profit. ServiceTitan recorded a strong revenue growth rate, about 26.63% year over year as of April 30, 2025. That's pretty attractive top-line expansion. It shows they're grabbing market share.
Right, that kind of growth definitely catches the eye. But the big question always is, does that growth actually lead to profit? Or is it just, spending to get bigger?
Well, yeah, if we connect that growth to the bigger picture, the company isn't profitable right now. It has a trailing 12 months net income. That's the last year's performance of negative $337 million USD. And the net margin, negative 21.5%. So that signals pretty clearly ongoing challenges to actually making money. It's a crucial point for anyone looking to invest. We're also seeing negative earnings per share, minus $6, which just reinforces that they're really in that investment phase, spending money to grow, not generating net income yet. Now, that's not automatically bad for a growth company. Lots go through this, but it's definitely something to watch closely.
Okay, that's a really significant detail. Like you said, many tech firms burn cash to scale up. How are they managing that from a financial stability angle? Especially debt. Are they just loading up on debt to fuel this growth?
Actually, on that front, it's a more positive story. The debt-to-equity ratio is quite low. It's 0.11. That implies they're being pretty conservative with borrowing, limited risk from, a heavy debt load, which it raises an interesting point, doesn't it? How can you have strong revenue growth, low debt, but still be losing money? It really points to that classic scaling up phase you see in these high-growth tech firms. They're prioritizing getting bigger, developing the product over immediate profit. They're investing heavily in the future, spending a lot, but at least they're not primarily using borrowed money to do it. That's somewhat reassuring.
Right. So high growth, low debt, but no profit yet. What does all that mean for the price tag? I mean, if it's growing fast but losing money, how do you even value something like this? This is where it gets, really interesting, doesn't it?
It really does. When you look at ServiceTitan's valuation, it's immediately clear the market has very high expectations. It's forward PE ratio now. Forward is key because they aren't profitable now. This is based on projected future earnings. It's incredibly high, 187.64. So think about that. Investors are paying almost 188 times what the company hopes to earn next year. That's a big bet on the future.
Wow, 187. Compared to what's typical in tech.
Exactly. A typical tech sector PE might be in the 20 to 40 range, so we're talking multiples higher here. And similarly, the price-to-sales ratio, or PS, that's around 12.6. Comparable SaaS companies, they often fall between 3 and 5. So yeah, these numbers strongly suggest potential overvaluation. They reflect just how much growth is already baked into the price. Investors need massive future earnings growth to justify these levels. Our sources didn't give a specific discounted cash flow or DCF number, but yeah, these high multiples imply the market's assuming really significant earnings growth down the line. That PE, nearly 5 times the sector average. It's not just high, it's a valuation built on, future perfection almost. It demands hypergrowth. Any slip up and the stock could really suffer. It's a bit of a high wire act.
So essentially, people now are buying the dream, not the current reality. Is there any scenario where paying that kind of premium makes sense, or is it just market hype?
Well, it really boils down to your conviction in that future growth story. If
Hmm.
you believe ServiceTitan can execute flawlessly, keep expanding, and eventually become highly profitable, then
Yeah.
maybe these valuations could be justified in the very long run. But the margin for error, it's razor thin. You really have to believe in a near perfect outcome.
Okay, understood. Fundamentals and valuation paint a picture of high growth, high hopes, high risk.
Let's shift gears a bit. What's the stock itself doing, on the charts? Trending up, down? What's the immediate technical picture?
Right, technically speaking, the current price is around $117.10. And it's sitting pretty close to its 50-day moving average, which is about $112.59.
Yeah.
So that suggests some recent bullish momentum. The short-term trend has been upward.
Hmm.
However, if you look at the broader picture, the 52-week range, it's quite wide, from about $79.81 up to $131.33. And with the price near that upper end, it does indicate the stock could be approaching a resistance level, meaning maybe some pressure for it to pause or pull back soon. Okay, so some bullish signs, but maybe bumping up against the ceiling. How strong does that momentum feel? And is it super jumpy day to day? What about volatility?
The momentum indicators,
Hmm.
like the RSI, the relative strength index, that's around 61.33. That signals moderate bullish momentum. Usually over 70 is considered overbought, so 61 isn't quite in the danger zone yet, which is potentially positive. And price momentum has definitely been positive overall. 67% green days in the last 30 trading days, so yeah, reinforcing that recent uptrend. But it is fairly volatile. It moves about 3.25% daily on average. Now, that might sound like a lot, but honestly, it's pretty typical for a growth tech stock like this. They just tend to swing more than, say, a big established company.
Right, like navigating choppy waters, as you said.
Hmm.
Good progress, but potential for big waves. So technicals show upward movement, decent momentum, but definitely with that built-in volatility. What about the general buzz? Beyond the charts and numbers, what are analysts saying? What's the market sentiment feel like?
Well, the analyst consensus is generally buy. The average price target sits around $122.38. That implies, a modest upside from the current price, maybe about 7.38% over the next year. The targets do vary, though, from a cautious $100 up to a more optimistic $140. So there's a range of views even among the pros. Importantly, though, there haven't been any recent downgrades or sell ratings that we saw. It's been stable with strong buy and buy recommendations, suggests analysts are by and large still confident. Investor sentiment, though, that seems a bit more tempered. The fear and greed index is at 39.
39, where does that fall?
It ranges from 0, which is extreme fear, to 100, extreme greed. So 39 is actually just inside the fear category, close to neutral. It suggests, cautious optimism maybe, definitely not wild enthusiasm from the broader market.
Huh, interesting split. Analysts mostly bullish, broader market a bit more hesitant. Highlights that difference between long-term projections and immediate feeling. Okay, looking forward then, what could really move the needle for ServiceTitan, up or down? Any key events or catalysts coming up?
A key short-term one, definitely, is the earnings report. That's due on September 5th, 2025. That could really impact the price. Strong results, weak results, even just their future guidance, that can shift things dramatically. Longer term, potential catalysts could be things like launching new products, more contractors adopting SaaS in general, which increases their market, maybe even some M&A activity, buying smaller firms. But, nothing explicitly flagged as immediate in the sources. And of course, the broader macro environment always plays a role, especially for tech and SaaS. Think interest rates, economic growth, that stuff matters.
Makes sense. Earnings are always huge, and the wider economy sets the stage. But that brings up the flip side risks. What are the potential pitfalls here? What could go wrong for ServiceTitan investors?
Yeah, there are definitely risks to consider on several levels. First, stock-specific things. We've talked about the negative profitability, right? That's a big one. Those very high valuation multiples, they leave almost no room for error. If growth slows down even a bit, the stock could get hit hard because so much growth is expected. Then there are sector risks. The size and tech space changes fast. New competitors can pop up, demand can shift. That's just the nature of the industry. And finally, macro factors. Interest rates going up, market volatility. These tend to hit growth stocks harder because their future earnings are valued less in that environment. While the sources mentioned volatility is moderate now, around 3.25% daily, it's still a factor. The trading volume, about 526,000 shares daily, suggests decent liquidity, so you can likely get in and out reasonably well. But yeah, being volatile and near its highs, that definitely hints that short-term pullbacks are a real possibility. It's a classic high reward, but also high risk scenario.
Okay, so we've pulled together all these threads. The strong growth, the lack of profit, that sky-high valuation, the upward technical trend, the analyst support, but market caution. and all the risks. Let's get to the bottom line. Is ServiceTitan a good buy now, and who is it really suited for?
All right, based on everything we've looked at, ServiceTitan comes across as a moderate risk growth stock. It seems best suited for investors who have a medium, maybe even high tolerance for risk. Our overall suitability score came out at 5.5 out of 10. It has that promising revenue growth. Analysts seem to like the story. But the lack of profits right now and that really lofty valuation, those require careful risk management. For anyone thinking about jumping in, price matters. Given that high valuation, getting in near to the $100 to $110 range would likely offer a better risk versus reward setup. However, the current price, around $117, it might be considered reasonable for short-term traders. Those looking to play potential moves around catalysts, like that upcoming earnings report.
Got it. So definitely not for the conservative investor, and entry timing looks pretty key. What about the investment horizon? Is this something you'd hold long-term, or is it more of a shorter-term opportunity?
Yeah, it definitely depends on your strategy. For short-term traders, sure, there might be opportunities here, capitalizing on momentum, maybe playing the earnings announcement. But caution is really key because of that volatility. You'd absolutely want clear stop losses in place. The sources suggested maybe around $108, about 7.5% below the current price. And for taking profits, maybe aiming near those analyst targets, say $122 to $130, perhaps scaling out as it approaches resistance. For long-term investors, though, I think it would be more prudent to wait for clearer signs of consistent profitability, or perhaps wait for the valuation to come down a bit, maybe in a market correction. That would make it more attractive for a long hold. So ultimately, at these current prices, ServiceTitan seems better positioned as maybe a short to medium-term trade, centered around potential catalysts rather than a core conservative long-term holding.
That's a really helpful distinction. Different strokes for different folks, and different stocks need different approaches. Okay, here's a final thought for you, our listener, to chew on. We've talked a lot about the high expectations baked into ServiceTitan's price due to its growth, despite the lack of profit. But what if? What if they do manage to translate that strong revenue growth into consistent profitability? How might that fundamentally change the investment picture here, especially given where they sit in the market? Something to consider as you weigh that balance between future potential and today's financial reality. Thanks so much for joining us for this analysis of ServiceTitan. We hope this breakdown helps you in your own investment journey. Keep exploring, keep questioning, and we'll talk to you next time.